And I want to start with the economy. I know you're confident that it's going to continue recovery this year. You said that a couple of weeks ago in a speech. We've seen now some signals that maybe growth is picking up a bit. 3 weeks of jobless claims falling, the ADP private job gauge more strong than people were expecting, the ISM manufacturing and services gauges remaining strong. Do you think with the stimulus that was passed at the end of last year, and the fact that viruses are coming down now, the cases are, the economy is picking up some steam?
Yeah, Kathleen, I think it's encouraging the progress that we've seen in the economy, the supports that have been provided to this point. I think around all of that, of course, we can't forget that the real driver of the outlook continues to be the virus. And as we watch the promise of the vaccinations coming out, as we see how readily people will take those, how quickly they can be deployed, that, of course, is what is going to ultimately shape the recovery as we look ahead.
So basically, you and others have said this at the Fed, the recovery is ultimately about the vaccines. It was the virus, now it's the vaccines, how quickly they come out. So what will a successful rollout look like to you? A successful rollout, the kind that could actually give this recovery we see so far some momentum?
So the way I think about it is when the virus no longer factors into our day-to-day decision making, then I think we might feel like we're out of the woods. So what does that look like? It certainly will depend on broad-based immunities, herd immunities, as it's called. And I think once people can resume mobility, can resume activities, that will be the signal, I think, that we're on track to complete the recovery. I think until that, and again, as you hear about new strains, as you hear about some of the logistical problems with getting the vaccine out there, that can extend the timeline. But I think there's certainly every reason to be positive that once those pieces are in place, we ought to be able to see the economy pick up and see jobs return again.
What kind of growth, GDP growth, is your team looking at, you and your team, based on what you see so far?
So I think, again, depending on when you think we could get to this broad-based immunity, thinking about the second half of this year, that maybe we could end up the year in a 4 to 5% growth range could be possible. But that, of course, again, you caveat that we're not out of the woods yet. We have to wait and see whether that actually materializes. The further we push into third quarter, fourth quarter, in terms of accomplishing that, you could see that kind of outlook begin to push out into 2022.
You know, the other part of your optimistic outlook, cautious, right? But nevertheless, seeing this recovery continue is based on, so far, even just the stimulus in part that we saw at the end of last year. So if you can see 4 to 5% growth this year, assuming the vaccine rollout goes well, does the economy really need more stimulus at this point?
So I think the way I think about the stimulus we've seen, or actually I refer to it as relief, because remember, we've come into an extraordinary shock to the economy. And as I look at the progress the economy's made so far, it has been very important to see the supports that have come to households, the supports that have come to small businesses. So I hear from a number of my contacts how important the Paycheck Protection Program has been to sustaining them. So that tells me that those supports were important in terms of achieving the outcomes we have. Of course, those that are making decisions about whether further support is needed are having to factor in how much more is needed. And all I can say is we know that's been important so far. We see light at the end of the tunnel, thinking about the vaccinations, the virus getting behind us, filling that gap. Will have to be a judgment that our fiscal policymakers think about in terms of making sure we can extend the recovery.
So I want to ask you some questions about financial stability. Calling, of course, on your background, which is unlike a lot of other Fed officials at this point. You came up on the banking side, the bank regulation, the bank examination side at the Kansas City Fed. You've actually had to shut down banks that were in trouble. So you know what this can start to, what it looks like, perhaps. You know what some of the signs are. When we look at GameStop, the retail trading frenzy, the short sellers, you're not the SEC. You don't have to comment about that. But as a bank regulator, which you are in part at the Fed, is there anything in this that could lead to financial instability if this kind of thing continues?
Well, you're right, Kathleen. Financial stability is really an essential condition to the Federal Reserve being able to achieve its mandated goals for full employment and price stability. And so looking carefully at what vulnerabilities are in the economy is critical, I think. And we know from past recessions, 2001, 2008, came about because of vulnerabilities in the economy. So it's an area I keep a close eye on. Markets, of course, are going to experience volatility. But I think looking broadly at a set of vulnerabilities, thinking about the capitalization of the banking system are all very important indicators and conditions for us to be successful in delivering on our mandate.
You know, Treasury Secretary Yellen met with, representative from the Fed Board of Governors, the New York Fed, the CFTC, the SEC. And the statement the Treasury has put out is that the Treasury says the core market infrastructure has been resilient amid this retail trading frenzy. If you had been at the meeting today, what would you have advised Treasury Secretary Yellen to think about, to watch for on this, and anything you might see as a particular potential threat in all this?
Well, I think the issues that they're focused on make a lot of sense. They're the right ones. We need integrity. We rely on fair markets and their smooth functioning for our economy to work. And it sounds like that's exactly where they were focused.
So what about the criticism that many have made of the Fed's ultra-easy monetary policy, that key-rated zero, cheap money, capped bond yields are forcing investors into more risky assets like stock? And this is the kind of thing, too, that could lead to something that feels a little frothy, like a bubble, which ultimately could be financial stability. How do you answer that criticism? Do you see any truth in it?
Well, I think it is true, of course, that when you have ultra-easy financing conditions for a long period of time, it can create incentives to reach for yield. It can cause some to misprice risk in markets. But my own view of where we sit today, the real priority right now has, again, been addressing this extraordinary shock. And the Federal Reserve right now is far away from what I would say is achieving its objectives. And so in that context, it means you have to, again, be very vigilant. You have to be watching for those excesses, but understanding certainly there are risks at a time like this that you keep an eye out on.
What about the whole question about when the Fed will taper? I know you have said, well, the economy is still healing. It's premature to talk about it, but you've also said that once the pandemic is behind us, there's considerable scope for a snapback in activity. So are you wary or hoping even that as the vaccine rollout gets into play, if growth picks up, that could then put this whole tapering question on the table, maybe in the second half of this year?
Well, I think we're all hopeful that we will see this economy continue to heal, whether it's a snapback in activity. That is the desired outcome, that we begin to see substantial further progress toward our goals before we have a conversation about when it's time to remove accommodation. So I continue to think it's too soon to try to speculate about that. And again, until we see the path to getting past this virus, it will be difficult to make any prognosis about when that time might come. But certainly looking for signs that this economy is healing, that we're beginning to see progress, will put the Federal Reserve in a position at some point to begin to consider those issues.
Well, one more thing to put on the table then. Inflation, you've said it could reach the Fed's average inflation objective more quickly than a lot of people expect. We're seeing signs of supply constraints due to the COVID virus, worker shortages, rising prices paid in the ISM report on manufacturing. Is it possible that we do get to 2% faster, and how patient will you be? And again, is this something that maybe pushes that tapering debate closer?
So as you know, Kathleen, the FOMC's new framework is really one that does call for patience. It, I think, signals that the committee is interested in achieving its 2% inflation objective over the long run in a way that will not be preemptive as maybe we have been in the past. And so I think looking for signs of how the economy is unfolding, how inflation performs, and you pointed out a couple of things. It could be muddled for a while because we do see there are places where there are supply constraints. We also continue to see some deflationary effects from those areas of the economy that have been hit hardest by this virus. So it will take some time to understand how the dynamics of inflation are going to unfold. And even then, I think you will find the FOMC has signaled it's going to be patient as it looks for the data to really support it's on track to achieve its objectives.